we're all kind of like, we don't know what's going to happen here September 17th. The Fed has a dual mandate and they have to. So, the dual mandate, for the listener that doesn't understand that, is they have to keep inflation in check because it hurts consumers if that goes too high.
Despite a large number of government layoffs, unemployment has been really steady, right around 4.2% unemployment rate. And so, again, you got to give them credit. You know what is historically one of the slowest times for showing properties? Take out Thanksgiving and Christmas, but like a regular month, one of the slowest times is the month of August.
We were in negotiations. Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you could build on. I'm your host, Kevin Amolsch. This has been such a fun, fantastic podcast to be a part of. We're getting some great guests. Today is no exception. This is one of our special Market Pulse updates in Denver. So we have our good friend, Mr. Joe Massey here. I know you're going to get a ton of value out of this one, especially if you're investing in the Denver area, which I know a lot of you are. So please help us out. 5-star review, share it with a friend. That helps us build a community to help more real estate investors just like you. So with that, I don't know that we really need an introduction here, Joe, but why don't you, first of all, welcome to the show and tell us a little bit about who you are.
Oh, Kevin, thanks so much for having me on, man. This is one of the highlights of my quarter every year when I see this on my every quarter when I see this on the calendar. So thank you for having me. My name is Joe Massey, and for many of you longtime listeners or followers, for 15 years I was with Castle and Cook Mortgage, and just recently have changed to Synergy One Lending. So Castle and Cook was a wonderful place to work. I made a lot of friends, closed a lot of transactions, but it was time to do something new, and now working at Synergy One Lending, and have been here for a whopping 10 days and learning a lot and trying to figure this out, but I'm really excited about it. So anybody out there that's interested in mortgage finance, please call, text, email. My phone number is still the same, 303-809-7769, but I do have a new email, jmassey@s1l.com. But outside of that, everything is status quo, man. Still doing loans, still talking to investors, talking to property flippers, talking to guys like you every single day.
I love it, dude. And I got to tell you, it caught me a little off guard. Like we don't talk every day, but we talk frequently. And I got an email from you that was like one of those just normal blast emails. Hey, I'm moving. You didn't even tell me, dude. This was like, you caught me by surprise a little bit.
That is not true. You just don't check your voicemails, because I called my entire database and I started with the A's. So Amolsch was one of the first ones I called and said, "Hey, Kevin, want to let you know I've made a change."
I have a complaint to the cell phone company because I promised you.
I guess I should have maybe sent a carrier pigeon.
There you go. I would have got that for sure.
Yeah.
Well, congratulations on the move. I'm sure if you made that
Thank you.
move, it was a positive thing. So congrats on that. Excited to
Thank
hear
you.
more about it. Maybe after we stop the recording here and hear more about it. Yeah. And how it's going to benefit you and your clients. Cause I'm sure if you're making a move like this, it's for a good reason. So
Yeah, would love to talk about it. It's going to be a big move for real estate agents, investors, clients. I think it's going to be super positive, but we'll talk about that later.
Yeah, and if there's a part of it you want to talk about while we're recording, well, let's do that too. But let's get into the market pulse here in Denver. I know you got some slides you want to share, but I want to go on a little macro level first. I know you're going to talk about sentiment because that was important to you, and there's a couple of other things on a macro level. But I just did the market pulse recording for our Minnesota listeners this morning, and we're all kind of like, we don't know what's going to happen here September 17th. The Fed has a dual mandate and they have to. So the dual mandate, for the listener that doesn't understand that, is they have to keep inflation in check because it hurts consumers if that goes too high. So we got to keep that as pretty much as low as possible. They've said the target is 2%. And then on the other side, they have to keep unemployment low. So employment high, unemployment low, because if people are working, then obviously that helps them too. So both mandates are positive. They both help the consumer. The problem, Joe, right now is we have that recent jobs report that came out, which is the worst one since the 1960s, I've heard, because of the revisions. Over 250,000 less jobs than they thought they originally reported to us, right? So significant. And on the same hand, we have inflation numbers showing signs of increasing. In fact, some of the numbers are in fact increasing. So how does the Fed handle this?
That's a tricky question. And you know what? I'm really glad that I don't work at the Federal Reserve because that's a tough job in any market, but it's a really tough job right now because the inflation and the unemployment, they're almost headbutting, right? They're almost conflicting priorities. And I've got a couple slides that will talk about inflation and unemployment. Uh, I believe that based on the Jackson Hole Symposium that was just last week on Friday, I believe we're going to see a small cut to the federal funds rate on September 17th. But I also believe that's already been baked into the predictions with 10-year treasuries and mortgage-backed securities. So if you're listening to this and you're waiting for September 17th to see the Fed funds rate hopefully go down, and you say, all right, that's the day I'm going to buy a home, or that's the day I'm going to lock in my rate, you might not want to do that because it's already kind of baked in, because I think it's something like 75% of analysts are predicting that 25 basis point cut. So it's kind of already into long-term estimates. But if it does happen, that'll certainly help car loans. It'll help credit card rates, things like that. And I think it'll help sentiment. I think it will help consumer sentiment, which is not part of the Fed's mandate. But I think people seeing headlines that, hey, the Federal Reserve has lowered rates by 0.25%, everybody's going to take a little bit of a sigh of relief and help some people get off the sidelines.
Oh man, that's a good point that did not come up in our call this morning. That what happens on the 17th really is going to impact sentiment. Now, yeah, I'm looking at the Fed Watch tool right now, and as a reminder, this takes basically futures transactions. So it's the market predicting what the Fed is going to do is basically what it is. 87.1 as of right now, and it's actually gone down a little bit from this morning. 87.1% chance of a 25%. 25 basis points cut. So
Wow.
to your point, if they do, status quo. If they do not, because they're a little concerned with these inflation numbers, that's going to be a problem.
Yeah. Yeah. If rates do not go, if the short-term Fed funds rate is not cut on the 17th, you're not going to see everything remain the same. You'll actually see long-term rates go up because it's going to be a shock to everybody, and everything is going to get revised up with mortgage-backed securities and 10-year treasury buyers. And that'll be a pretty big shock if that happens.
You know what the Fed funds rate is interesting, and you know this better than most, so maybe you could help us understand. There's very little, I say almost zero, but it's not zero. It's close to correlation between the overnight rate and the 10-year. And the 10-year and the mortgage rates are like 100% correlation,
Yeah.
right? So we really want to look at that 10-year and the short term, and there's just not a lot of correlation there. So I don't want anyone to get hung up on whether they cut or not if it's going to impact mortgage rates, because it could, yeah, but it could go the opposite way. We've seen rates last time they cut, mortgage rates went up. So
That's right.
you don't really, I wouldn't, for the listener, I wouldn't really put too much weight on it. Where you might want to put weight on it is your savings accounts, because if that rate gets cut, your savings rate will get
Savings
cut
is going to go down a
immediately.
little bit.
Yeah, exactly.
Yeah, those are directly correlated, and not that great. You know, when the Fed funds rate was what, or prime rate was 8, your savings account went from 0.02 to like 3 or 4. So there's a correlation, but it's not a dollar for dollar or a percent for percent correlation.
Yeah, and
But
that's
you will,
why I think
when they go down, you'll see your savings rate go down.
exactly, it's immediate. And so that's why you've seen a lot of people move from stock into debt, which is why rates have come down recently. Because if you could lock in a 10-year rate now, then you don't have to worry about that rate coming down, right?
That's
So
right.
the money has already moved into the bond market, I believe, and I think that's to your point. So the rates mortgage rates are going to be pretty stable, I think, regardless.
I think so. Yeah, because
Yeah.
I think there's, as you just pointed out in the futures watch, there's only a 13% chance that rates stay the same. The Fed funds rate stays the same. So pretty good odds that it'll go down, which means mortgage rates will stay roughly the same, maybe a slight improvement, but I don't think anything to write home about. Nothing
Yeah,
that's going to significantly move the needle. We're not going to 4%. That's the prediction I'll make today. Mortgage interest rates are not going to 4% in the next 3 weeks.
exactly. I'll get on board with that prediction with you.
Thanks.
Yeah, so 13% no cut, 87%, 25% cut, 0% chance, according to this, of higher than 25 basis points. So I know I've heard some rumblings that maybe it's going to be a bigger cut. That's not what the market thinks. So,
I agree.
all right. Anything else on Fed funds rate? Anything like that you want to cover before we get into your slides?
No, I'll go ahead and do a screen share and let's take a look at it here.
It is there. So just a reminder, we have lots of listeners listening in their car. It may not be able to see it. So we're going to do the best that we can to describe what we're looking at here. But for those of you on YouTube, they will be able to see it.
Yeah. So I put this together with one of my good friends and business partners, Mr. Lon Welsh over at Ironton Capital. He is a terrific data analyst and really provides a lot of value in breaking this stuff down in the way that we can make it bite-sized chunks for you. So I love this top line here. Headlines do more to terrify than clarify. Consumer confidence has really soured after extensive tariff discussions in the media. And in July, which is the most recent month that we have, expectations were mostly unchanged while sentiment was up a little bit. So on the left-hand side, what you see is expectations. And there's a blue line, which is the 3-month rolling average of consumer expectations. And you see it is at a low for the last 10 years. So consumer expectation is at roughly 80 on the scale. And the level of 100 means that things are average. 80 means our expectations are below average. Greater than 100 means our expectations are above average. So 80, this is the lower consumer expectations in the last 10 years. But over on the right-hand side, you do see sentiment, which is where do the consumers think that things are going to be going in the future? And that is trending upwards. So I do think sentiment is on a little bit of an upswing, which will then bring expectations, hopefully in the future, onto an upswing as well. But right now, there's just a lot of negative expectations out there. But I think that's, according to this chart on the right, going to be changing, hopefully in the near future.
All right, so help me unpack this for a second, Joe. I know
Yeah.
sentiment, we all understand consumer sentiment. It's a pretty important leading indicator. I don't know that I've seen the expectations before. So can you help me understand the difference between sentiment that is already on the rise and expectations that seem to be maybe either free falling still, or we just don't know? I know you're
Yeah,
hoping it goes up, but I don't see
it's
that what I'm looking at. So
very difficult to see, but right down here, the black dotted line is the monthly data, and you can see that it flattened out in the most recent report. And so I think when we see this report in 2 or 3 months, these black dots are going to be trending back upwards right there. So it was really falling, that expectations we're thinking are getting worse and worse and worse. Last month, it flattened out, and I think we're going to see expectations begin to kind of climb in line with the sentiment that we see over here in the right. So sentiment, what I would say is kind of a leading indicator of expectations.
So expectations is like what I'm expecting as a consumer in the overall economy. Like it's a very broad view. Is that what I'm looking at?
Yeah, I don't exactly know how the University of Michigan does this study, but I think they say it's a series of questions, and I would imagine one of them is, do you expect to be better off or worse off
Oh, okay,
12 months from now, right? And then sentiment, how do you feel about things right now, right? I feel like things are pretty good. Do you expect to be better or worse in 12 months? I expect things to be about the same, right? So I think it's a series of questions that leads them to this data analysis.
Got it. Okay. So both of these are looking fairly positive, and I gotta believe it's I can't believe I'm about to say this, Joe, and totally disagree with me if you do. It seems like there's some stability with the tariff talk.
Yeah.
There's a lot of deals are done, and you're just not hearing about it as much. So maybe that's part of this.
Yeah, I feel like deals are getting done, right? Which is a positive thing because Wall Street and consumers like certainty. Nobody likes uncertainty. So I feel like we're getting to where, okay, tariffs have been announced. Now they're getting finalized. Okay, we're kind of seeing what it's going to look like. And guess what? The world has not ended, which is great. And so people are saying, okay, maybe this is the new normal, right? Or maybe it's not even the new normal, but it's the new, we're adjusting to things. So I think you're exactly right. It's not in the headlines as much, so it's not at the forefront of everybody's mind. And so we're seeing this. How are you doing now? I'm doing pretty good. How do you think you're going to do in the future? About the same, right? So I think the free fall of consumer expectations and consumer sentiment, I hope, is over. And we're going to get back to, roughly a 100 level on expectations that, yeah, we think things are okay and moving along pretty average.
Cool.
So the next one I've got is in regards to buying and selling a home. So consumers have gotten really pessimistic about the market. And I think this is really going to touch on a lot of our listeners that are maybe fix and flip investors or long-term investors. So the percentage of people that agree that it is a good time to sell, that is pretty low, roughly 50%. That's the lowest that you see over the last 10 years, with the exception of the COVID lockdowns. So if you think about back in, early, or I guess mid 2020 and into 21, when things were really going like gangbusters, everybody thought it was a good time to sell. Well, where are we at now? Only roughly 50% of folks think that it's a good time to sell. Now, what does that do on, is it a good time to buy on the demand side? Holy cow, we're at the lowest in the last 10 years. So back in 2017, roughly 75% of people thought it was a good time to buy. And you see that go down a little bit. And then at the end of COVID, you see interest rates really go up. And then a ton of people say it is a bad time to buy. I'm going to wait for interest rates to go down. So March of 2022 is when we saw interest rates increase above 4%. And that's kind of right in this range here. And then ever since that time, interest rates have been relatively high, 6, 7, sometimes as much as 8%. And that leads a lot of people to believe it is not a good time to buy a home right now. So I differ in my opinion, and we'll talk about that in a few slides. What do you think, Kevin? Do you think it's a good time to sell, or do you think it's a good time to buy, or neither?
Gosh, put me on the spot here because I think it's always a good time to buy, and I think it's always a good time to sell.
Mhm.
And I find this very fascinating when I'm looking at, because you're right. If you're looking at good time to sell, 50%, that is, with the exception of COVID, the lowest in the entire chart that you have here. So
Yeah,
legit 10-year chart, well, very close to 10-year chart. This is the lowest it's ever been. So that's a little concerning, clearly. And
yeah,
I guess that would make sense why. I mean, maybe that's part of the lock-in effect. Maybe it's just part of just confidence in buyers. I don't know, but that's fascinating. And then to combine that with a bad time to buy as well. It can't be a bad time or a good time on both sides. So,
right.
but that's what consumers are telling us. So that I just find that I find that a little interesting and a little concerning.
Yeah, and I think what this ties to, if we were to look for like a numerical metric, this is where we see just lower transaction count. There's just a lot of people kind of hunkered down. I'm not going to sell, I'm just going to wait. I'm not going to buy, I'm just going to wait. I'm going to sit on the sidelines. And we're seeing that if you talk to any real estate agents, they're all saying, man, there's just not a lot happening. Some homes are transacting, but just not the way we were accustomed to it. There's just a lot of folks sitting on the sidelines. And if we were to look at the number of transactions last year in 2024, was right at 4 million. I think it was like 4,050,000, something like that, 4.05 million homes transacted in the United States. At the beginning of this year, a lot of leading economists predicted that to be up to 4.5 million transactions just recently, and I don't have the stat in front of me, but that has been revised down. They think year over year, 2025 transaction volume will be right around 4 million, maybe even below 4 million. And that is really low. That's the lowest number of home sales since 1995. And if you think about 30 years ago, there was a lot fewer people in the United States than there are now. So if it feels like kind of nothing's happening, this is why. There's just a lot of folks saying, it's not a good time to sell. It's not a good time to buy. I'm just going to continue to live here, whether I'm owning or whether I'm renting, and just raise my children. I'm not going to make any big changes, which goes back to the prior slide of sentiment. A lot of people are nervous.
And we talk about the interest rate acceptance, And if I'm not looking at this chart, I would make the argument. It's the market has accepted the higher interest rates. People are willing to buy right now, and we're seeing transactions. But what you're saying, or what this is saying, that might not be true. And I
Yeah.
know there's a lot more to this than just the interest rates, but
I think certain individuals are willing to sell. And the example I always use, people that are getting divorced, people that are getting relocated for a job, people that have maybe had a death in the family. Life goes on, right? Regardless of the economy, if you're getting divorced and you have a major change in your life, you probably have to sell. And maybe it's not a good time to sell, is what you might think, but hey, you have to sell because you're getting divorced or getting relocated or whatever it might be.
that's fair.
And a lot of folks are saying, hey, it's not a good time to buy, but I'm being relocated, or I hate my neighbors, or I have to get my children into a better school district. And while the sentiment might be it's not a good time to buy, I have to or need to for one individual motivation or another. So I do still think there's a lot of transactions, not a lot. I think there are transactions happening, but on a macro scale, not the 6 million that we saw back in 2020 and 2021.
Yeah. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com.
Let's talk a little bit about inflation. So really, if you look over here to the far right-hand side of the chart, inflation is pretty steady now, just below 3%. Now, most recently, Kevin, you touched on this, we are seeing some of these numbers begin to trend back up. Now, we're not seeing them trend up to 6, 7, 8, 10%, but we are seeing from, the target of 2%, we're seeing inflation 2.3, 2.4. I think the most recent reading was 2.6, and it's going in the wrong direction, which that might be part of that 13% chance that the Federal Reserve does not cut short-term interest rates if there's another inflation metric between now and September 17th. And I can't remember if there's another report or not. But for the most part, inflation is pretty steady, and you got to give some kudos to the folks at the Federal Reserve. They're actually doing a pretty good job. Especially if you compare back to the middle of 2022 when inflation was over 9%. So
Yeah,
you kind of you do have to give them some credit.
I do give them credit. I think they're doing a fantastic job, by the way. And I think they would be a mistake to cut the rate. Now, I know that's not going to be a popular opinion. I understand that. But if you're telling me your target's 2, which I don't agree with that, by the way, that's well below like a 50-year average.
Yeah.
Let's say that is it. You're not there, nor are you heading that direction. So cutting would be a contradiction to what you've been telling us for the last 3 years.
Yeah, I agree. And then their dual mandate unemployment. So despite government layoffs, we all remember the Doge cuts that happened, I guess now almost 6 months ago. Despite a large number of government layoffs, unemployment has been really steady, right around 4.2% unemployment rate. And so again, you got to give them credit. They're doing pretty darn good, ignoring this, the COVID layoffs back here in 2020. It's been pretty steady unemployment rate for like the last 3, almost 4 years. So they're doing a pretty good job. And again, I kind of agree with you, Kevin. I think cutting by 25 basis points is probably the wrong decision, but I do think it'll happen.
Yeah, I totally agree. Yeah,
and everybody that disagrees, we don't want any comments on YouTube for that little section right there.
To put this in perspective, 4.2 is low. And it's not like ridiculously low, but it is low. So what they call an efficient market, this is the way I understand it. 5.5 is a efficient, basically like a one person looking for a job sort of thing.
Yep.
So anything under that is generally considered to be a strong employment market.
Yeah. Yep. Now, let's talk a little bit about inventory. So we didn't really touch on anything locally. but nationally, inventory is down 13%, right? So you hear a lot of folks, and this is where it's tricky when some folks say, is it a good time to buy? Is it a good time to sell? Well, nationally, inventory is down as compared to July of 2019 pre-COVID. But we're here in Colorado and we're doing the Colorado market update. Inventory is up almost 30% in Colorado, and that is worse for sellers. So let me ask you this, Kevin. Are you seeing your property sellers that you have funded fix and flips loans for, is it taking them longer to sell? Are you seeing payoff times stretch out?
Yeah, let me actually address that by giving you like sharing a little color here. I
Yeah.
don't know what are you, so you're looking at July data here.
Mhm.
And so now we're already, almost through August. And I do believe that things have changed between this data and what we're looking at
It's
today.
true. Yeah.
So I will say yes, but your data feels exactly accurate with what our clients are experiencing. Longer days on market. I know we'll probably get to that, but it's almost 40 here in Denver now. So you're
Hmm.
seeing that go way up. And it is taking longer to pay off our loan. So now you've got to adjust when you're underwrite your fix and flips, are you adding enough holding costs into your budget to handle that extended marketing time? Now, with that said, here's where I want to add some color. There feels like there's a little bit of buzz here, Joe. Our clients are calling us. Yeah, we're finally getting activity. We're finally getting showings. Um, I don't know if that's showing up in data anywhere because I don't track this like you do, but I am
Yeah.
hearing that it feels like the market is starting to loosen up a little bit.
Yeah, so I do have a slide for that, I think, here in a couple slides. And I'll tell you something that we forget every single year. Do you know what is historically one of the slowest times for showing properties? Take out Thanksgiving and Christmas, but like a regular month, one of the slowest times is the month of August. People are on vacation, people are getting ready for back to school. And once you pass over Labor Day, it always picks up in September and October. And we forget, right? We think that August is part of the summer selling season, and it is, but there's a lot of people that are they're not even thinking about it. They've already moved into their new home, they're getting settled for school or whatever it might be. And every year in August, we're like, man, it's so slow. When was the last time it was this slow? Oh yeah, last August, right? But we forget about that.
That's
So I
funny.
think you're exactly right. So I think a little bit of it is the seasonality. And the other thing is we're going to touch on, there's been a little bit of improvements in interest rates. And when rates are high, it doesn't take much of an improvement to get people off the fence. And I think we're experiencing both of those. We're getting out of the August doldrums and we're getting a little bit of relief on interest rates. Now, we spoke about inventory build. We don't have to touch on that again. Let's talk just a little bit about falling home prices. So 22 of the 50 largest metro areas have actually experienced reduced home prices. And Denver's over here on the right-hand side, for those of you listening, right at 3% reduction in prices from June of 2024 to June of 2025. Now, this can be a little tricky. This doesn't mean that every home went down in value. What this means is transaction volume is occurring with lower prices. Now, that could be a product mix variance problem, meaning if you sell more homes at the lower end of the market and fewer homes at the higher end of the market, the average or median price might be lower. But also, we have seen some anecdotal evidence of homes that were bought 3-5 years ago for 800,000 are now selling for 775 or 780,000. So we have not seen this big run up in prices, but we're also not seeing a crash in prices. What are you experiencing, Kevin?
Yeah, I believe this to be true. There was a lot of people that will say we have already been through a recession or are currently in one, and real estate tends to be first in, first out. So
Mhm.
when you look at something like this and you have almost half of the metros experiencing some correction, first of all, it makes perfect sense and it's normal and natural.
Mhm.
Um, with all that said, it's like no reason to panic here. Now, I would panic. I would push the panic maybe slightly on the attached product, which is a whole different world
Yes.
in Denver. But what I'm
Yeah.
looking at here, I mean, I don't know if that does that freak you out. I mean, 3% over a year when we're absorbing these higher interest rates and low transactions, it seems normal.
No, no, we're going to revert to the mean. And I think I have a slide in here. No, I didn't put it in here. Excuse me. I think we're going to revert to the mean. we had a number of years that home prices appreciated 10%, 15, 20% in some pockets. If we have to give back 3% this year, maybe even 5 to 7 to 9 to 10% if you have a condo, I don't think that's the end of the world. If you're in a position where you don't have to sell, don't. Keep doing what you're doing, continue to live in the home. Yes, maybe you're going to experience a paper loss, but I think we're going to revert to the mean of 3, 5, 7% appreciation, which is what we've experienced on average over the last 50 years in Denver. Now, this year, a little bit of a bad year. If you have to sell, it's going to stink to have to sell for 3 or 5% below what you purchased the property for 2 years ago. But if you bought the property 5, 10 years ago and you have to give back a little bit, don't cry too hard, because the property value has probably doubled in the time that you've owned it.
Yeah. And if you go back through history and look at housing recessions, they are very short, with the exception of
Yeah,
'08.
yeah,
They were in and out
absolutely.
of them quickly. So if history holds true, we're going to be on a rebound here. I would think we might even be in it like very
Yeah,
soon. So
yeah,
not that I'm promoting timing the market, because I hate that,
yeah.
seriously. But if you were going to try to time the market, when you see a dip like this, that might be the time.
Might be a good time to buy. And we're going to touch a little bit on that right here. Seller concessions. So with increased mortgage rates, you see that buyers are asking for more. They're asking for more inspection items. They're asking for price reductions. But the most important thing that a buyer can do is they can ask for seller concessions, because that can make a direct impact on reducing their money out of pocket and also reducing their interest rate and subsequently their monthly payment. And you see that in Denver, greater than 60% of homes in the most recent quarter had seller concessions. So if you're a seller, you need to be prepared to offer 1, 2, maybe even 3 or 4% of your contract price as a concession to the buyer. If you're a buyer, you absolutely should be negotiating for seller concessions. And if you find a property that's been on the market for a while, something at 75, 90, maybe even 100 days, you should absolutely be asking for seller concessions. And I'll tell you right now, Kevin, 100% of my clients are getting seller concessions. Not 95, not 80, 100% of the folks that I'm working with are getting seller concessions. Sometimes it's only $2 or $3 or $5,000, but one I have today is $16,000 seller concession. So I think you should absolutely, if you're a seller, be prepared to pay that. If you're a buyer, be prepared to ask for it. What do you think?
I agree. In fact, we teach when we're going through our Mayo max allowable offer to budget for that.
Yeah.
So 2 to 3% in a concession. A concession, I say it all the time, it's just a bribe, right? If you buy
Yep.
my house, I'll pay you this. That's what it is. And it's very common.
Yeah. Yeah. Very common right now. And then let's talk a little bit about withdrawn listings. So this is a chart, and again, for listeners, you can't see it, but it's very seasonal, that withdrawn listings go down in the spring and increase later into the fall and later in the year. But what we see on the far right-hand side of the chart is withdrawn listings are up to a level that we have not seen since, what, 2015? Withdrawn listings are on a really, really big run up. And this is somebody that lists their home, they've got it out there for 90, 120 days, and they just cannot get it sold. And they say, you know what, we're going to have to rent the property, or we're going to have to continue to live here. We just can't get the price that we want. And we're seeing a lot of this activity. So I'm really close with a large property manager here in Denver, and a lot of their clients in the spring said, hey, thank you so much. Y'all have done a great job. We are no longer going to rent this property. When the tenant moves out, we're going to put it on the market for sale. We really appreciate all the service that you've provided. And they are now getting as much as 1 out of every 2 properties that was listed for sale back in the spring is now coming back. And they're saying, hey, we're going to sign another property management agreement with you, and please rent our property for another year.
Just kidding.
Yep. Yep. So
So
if you've got
does
a property,
this
price is going to be really important to not be on this metric.
this does not make me panic. So I'm curious what you're thinking here, Joe. I love the data and I love the graph. It gives me a very visual. So for the listener, what I'm looking at is something that looks very seasonal. So
Yeah.
it's a lot of up and down, a lot of up and down. And it looks like it's in a pretty regular cadence, with the
Hmm.
exception of maybe 21 and 22.
Hmm.
So it is higher now than what it has been historically, but it's right on time.
Yep.
So what are your thoughts?
I agree. This does not scare me. I think a lot of these folks that withdraw their listings were unfortunately probably unrealistic on the price. And, a lot of folks want to get top dollar. I mean, everybody wants to get top dollar when you're selling a home. But ultimately, if you don't get top dollar, you can either stop trying to sell the property and rent it out or lower your price. If I'm a buyer, I feel pretty darn good about this. When I would be calling listings and making offers? Day 119, because what's probably just about to happen, they're thinking about taking it off the market on day 120. And so on day 119, I can probably get a lot of concessions and probably a price reduction and probably even get some negotiation on the inspection items.
I agree
So
with you.
this,
That's a
if you're a
great piece of
buyer, I
advice.
think, yeah, if you're a buyer, I think this is a very powerful, empowering chart.
Yeah, and this is something when you're negotiating. So youngest son, he's 16, Joe, and he's out there trying to fix and flip, and he's going to make his first seller call today. So we were practicing
Wow.
last night. We were going through the script, and I was giving him objections, and he was trying to overcome them. And this is something that may be beneficial for an investor to negotiate. Like, it looks like a lot of deals are coming out of contract or are being delisted because they're just not selling. This is a guaranteed sell. Are you interested in
Mhm.
something that's certain, or do you want to roll the dice here? Now, it's something language, something like that is what he was sort of working on last night. So this is good information.
Dude, give him my phone number. I love role playing with young investors. So I would love to take his call, and I don't have anything to sell, but he can practice with me. That I
I
would I would
might I
welcome
might
that
take you up on
opportunity.
that. He's quite nervous, I will say.
Good. Have him call me, and like the first time I'll be like, all right, I'm going to be a really nice seller. Then second call, I'm going to be a mediocre seller, and third call, I'm going to be a hard seller. And
Oh,
let's see what he can do. I would love
we
to
got
do
to
that.
record that and put it as part of the podcast.
Oh, that'd be great. That'd be great. So last couple I have here, Kevin, do you get folks asking you about foreclosures or when we're going to have a foreclosure boom?
Not as much as we used to, and I know you're probably similar. Everyone was quite
Yeah,
fearful of that. I think that's died down a little bit.
I
Maybe
agree.
because we're doing such a great job of showing in the data.
Yeah.
But yeah, there is some still concern out there, and we are hearing defaults going up. I think
Hmm.
I just saw a headline: FHA defaults are like not an all-time high, but they're definitely on the rise. And I know there's like
Yeah.
400 billion in commercial defaults right now. So you're hearing those things, but I don't think on the single family home business people are as quite concerned. Does that make sense? What I just said? As
I
concerned.
agree 100%. Yeah. Office defaults, certainly I would not want to own an office building right now. Certainly not a building that's in like a downtown area. I would be very nervous about that. But single family homes, condos, we have a leading indicator over here on the left-hand side for those of you listening that can't see it. Um, Less than 1% of homeowners are behind on their mortgage and did not make their mortgage payment last month. So less than 1% are behind on their mortgage. Now, what does that lead to? Foreclosure filings. And in Colorado, 0.1% of homes in Colorado are currently in the foreclosure process. That is like a staggeringly low number. And even in good times, there's always some homes that are in foreclosure. And this is kind of where we're at. We're at this really, really low number. This is not 1%, 3%, 5%. What was it during the 2008? I think it was like 13 or
I
17%.
know it was over 10. I do know that.
Yeah, yeah, that's a foreclosure crisis. 0.1%, even if it doubles and goes to 0.2, that is not a foreclosure crisis. So I don't think you're going to see any relief on prices because of a foreclosure boom. So I would encourage folks that are waiting for that, probably not going to happen. Um, any thoughts on that, Kevin, before we talk about?
Yeah, I was just looking across the map there across the other 50 states. I didn't see any of them over 1%. So
No.
which is exactly what I would expect. I mean, there's just not a lot of defaults, and shoot, why would there be? The underwriting is, you know, a ungodly amount better. Like, I don't know,
Yeah.
100, 200% better than it was in the past. People are actually qualified to have these loans, and we're
Right.
still at record, even though we're starting to see HELOCs to pay off debt and that sort of thing. We're still at record high equity.
Yeah.
Equity
Yeah.
creates options. Why would someone go into foreclosure when they got equity? So none of this surprises me.
Yeah, I'll touch on that just real quick on this chart. There is more home equity right now than at any time in history. And if you were to go back and look at, 2008 to 2010, as a country, we were actually upside down. We had more debt than equity. And now there is more equity than there has ever been in history. So if I have $300,000 of equity in my home and I lose my job, I'm not simply going to put my head in the sand and give that home back to the bank and lose all of my equity. What am I going to do? I'm going to call the real estate agent that helped me buy, and I'm going to say, you need to help get me out of this. And maybe they're going to sell it. Maybe I have to sell it at a little bit of a discount because it's, perceived as not a great time to sell, but I'm still going to walk away with $250,000 in that example. So as long as this equity line is so much higher than debt line, we're not going to see a major foreclosure crisis. So I don't think you have to worry about that.
I agree.
Now, the very last couple of slides I've got here is leading housing economists expect mortgage rate declines. So this is a little bit outdated. From a month ago when we put this together, rates were at 6.8%. Right now, we're right around 6.5%. The Mortgage Bankers Association and Wells Fargo predict we're going to stay right around that for the rest of the year, between 6.4 and 6.6. Fannie Mae is a little more optimistic. They're hopeful that rates will be down to 6% through 2026. I would be somewhere right in the middle. I think we're going to be right around 6.3, 6.5% over the next 6, 10, 12 months. What do you think, Kevin?
I'm glad you're showing this slide because this comes out from US News. It comes out very regularly. So the August 2025 is what I'm looking at right now, and it looks dead on to what you have. So
Yeah.
I don't think there's been much movement in their projections compared to what's today and what you have here.
Yeah. So, if you're hoping for a 4% interest rate and that's what's going to get you off the sidelines to buy a home, probably not going to happen. I would encourage you, the listener, look at your budget, figure out what does it take to buy a home with rates at 6.5%. And then if rates go down, give me a call. We'll give you a free refinance. It's a big part of what we do, that we take that risk that you can refinance with no closing costs whenever interest rates do go down.
That's such a great benefit, by the way.
Thank you. And then this is the last one I've got here, Kevin, and this touches on something you spoke about a few minutes ago. We're feeling it loosen up. It feels like things are getting better. And what you see on the left-hand slide, this line in green, is the purchase mortgage application index. And we're seeing that significantly higher than it was last year at this same time. I'd like to point out, look at July of last year and what happens in August, it goes down. What happened in July of this year into August, it goes down. But what happens after Labor Day, it goes back up. So I expect we're going to see the same trend. And what you touched on, we're feeling that right now, that your investors and your sellers are saying, man, it feels like stuff is starting to happen. I'm starting to get some traction. I'm experiencing more activity. And this is really that leading indicator for that. We're seeing applications because folks got to apply with me, get pre-approved, then they go out and look. So the slide on the left is very much a leading indicator. And we're right here where we're just going to be beginning that trend back up after this weekend's Labor Day holiday. So I feel very positive and bullish on the second half of the year. What do you think?
I'm going to ask you a question about this.
Yeah, please.
So first of all, I 100% agree with you. And I love the mortgage application data. And they even separate it between refis and purchases. So you could really get into that. I mean, that's the best way, in my opinion, to project demand.
Yeah.
But what I've had trouble with is this data comes out on a weekly basis. So every week this index comes out. What I haven't been able to do is find it like this, where I could look at a trend. Like it's just like, here's the index. It's better than it was last week. And I'm like, okay, well, that's only from 1 week to the next isn't really giving me a trend. And it's difficult. Like, what was it last year? What was it 3 months ago? That sort of thing. Is like, where are you getting this? And how are you able to put it in this graph like this? Do you know?
Yeah, Lon gets it actually from the Mortgage Bankers Association. We have kind of a basic subscription to their data portal.
So if you have the subscription, you can get the trendings.
Yep, and it's not expensive. I think it's $75 a month. I may be wrong on that, but yeah, with the subscription model, you can get much more robust graphs and charts And for the listeners, we do make sure that we reference this. We reference our sources. We take that really seriously. But my good buddy, Lon Welsh, Mr. Data Analysis, he finds this stuff and puts it into these bite-sized chunks for us.
Okay, that's cool. Yeah,
Yeah,
the weekly thing is just like, it's just too short of a time to really get a sense of what's going on. So to see
I
it
agree.
like this over the year, it makes it much more, I guess, you can get your teeth into it. It's much more tangible.
Yeah, especially looking at the gap from last year to this year.
Yeah,
Last
yeah,
year,
that's
man, we
great.
felt like things were so slow. This year, it's like, all right, it feels better, and we can look and see, hey, it is better. We're
It is
getting a
better.
lot more activity, especially starting in March and April, where that gap really begins to widen, and it's still wide. So for those of you looking at the screen, I apologize for all my bad handwriting and chicken scratch, but hopefully that made sense. And Kevin, those are the slides that I wanted to share. Anything that we should go back to or touch on again?
I don't think so. I think you did a fantastic job, but just give me like an overall. I mean, the data's great. I love it. You love it. The listener may or may not. I don't know, but give me an
Yeah.
overall like sense. Like, how do you feel? What's Joe Massey's sentiment?
You know what? I will tell you something that I don't share with a lot of people. I actually went onto Zillow last night when I was sitting on the couch and started looking at homes that I might be interested in buying. So I feel pretty good. I think that we have reached and passed rock bottom of transaction count. I don't think we're going to go back to 8% mortgage rates. I don't think we're going to go to 4. I think we're in a pretty normal market with a decent balance between buyers and sellers. I feel very bullish that the second half of the year is going to be good for the mortgage business. I feel like it's a good time to buy. I wouldn't be selling anything right now. I'm really happy with my investments. I'm happy with the cash flow that they deliver. But I actually, it's so funny you asked that. I, for the first time in years, opened up Zillow last night and started looking at homes to buy. And you know what I found? Some really good deals. I found a fourplex out there for like $900,000 that's been listed for, I think it was 142 days or something like that, right in Denver proper. I'm gonna plug the numbers in. It wasn't a killer deal. It was like a 5.5% cap rate, but I'll bet you there's some negotiation room. So I think there's some deals out there, and I feel really positive.
I would not buy anything with a lower cap rate than your debt rate.
I agree with
If
that.
you're looking for something, if the listener's looking for deals, because I see a lot of stuff trade at 4 and 5% caps, and I'm just
Yeah,
like,
I didn't buy it. Let's be
you're going
clear.
backwards there, guys.
I didn't buy it, but it was a long time you couldn't even find a fourplex,
I
and I
know.
found multiples of them just on Zillow. So
Yeah,
I
it's
think there's
pretty
still going to
amazing.
be some searching through the haystack to find the good needles, but I do think they're out there.
No, that's great. That's good feedback. I guess I feel similar. I wish it would just loosen up a little bit. So I do feel the market's tight. I
Hmm.
think that it will loosen up, but I also believe that with interest rates pretty much going to be flat, at least that's what most of the experts are saying for the foreseeable future, all the way through 2026, right? That was the graph you showed us.
Yeah.
I don't think that we're going to get any relief on the interest rate front. So where is that relief going to come from? I'm questioning that a little bit. But here's what I will say: as long as it's tight, we're not seeing values tank. Right? It just
Right.
can't. You need lots of inventory and low demand for that to happen. So we're not seeing that. So that gives me some confidence. But yeah, I guess overall feeling is good. I feel like
Hmm.
Pine Financial's in a good spot. I'm in a good spot. I'm buying also. I'm more on the commercial side now than the residential because I'm sick of tenants. But I do think it's still, I agree with you. It's still a good time.
Yeah. Yeah. That's what I think. And as we're wrapping up here, I really appreciate you having me on here, and I love talking about this stuff with you, dude. I could do this every single day. I think people would get tired of listening to us every day, but
I think you might
I'm
be
really,
right.
really grateful for the conversation, and to the listeners out there. I enjoy this stuff and happy to talk about this stuff one-on-one as well, anytime.
Well, one of the things I really pride myself on the Real Estate Educators podcast, Joe, is to be really raw. And I just try to be as honest as I possibly can. And so it's not like all raw, which is why I was a little hesitant. And I said, I wish it was a little looser of a, because that's
Yeah,
just the truth. That is
it's
really what I'm
the
feeling
truth.
right now.
Yeah.
So let's just be raw here. Tell us why the move.
You know what? I was at Castle for 15 years. Wonderful place. Was just time for something different. I was a little bit bored. If we're going to be raw, I was a little bit bored. Hadn't learned a whole lot. Had kind of reached the pinnacle of where I was going to be, and needed some new challenges. The change to Synergy has opened up some doors for new products, builder forwards, home equity lines of credit, lots of things that we can do for investors. So those would be some new challenges for things that I can learn that can really benefit a lot of our network and our clients. Again, nothing negative about Castle. There was no falling out. I'm still great friends with the CEO, great friends with a ton of the employees there. Was just time for something new. And I'm really excited about it. The folks here, it's a great energy, great collaboration. Sometimes it's like good to go to a new school. You're going to make some new friends and learn something new.
Yeah, that's a really good answer. Can you elaborate a little bit on what you see in the future? Maybe you don't know it yet, but foresee that will help your clients. And then is there any chance you're going to start doing like some commercial brokering, or is it you're going to stick to your lane?
Yeah, good question. We do have a commercial division. I am not educated enough to even talk on it. I know that we have a way that we can refer certain commercial transactions out. So maybe next quarter we can touch on that because I will learn a lot more about it. But I'll give you one thing I've learned a lot about for investors. So Kevin, you're familiar with DSCR loans.
Yep.
And if you look at those withdrawn listings, so something that you and I work together on a lot is somebody has a fix and flip and then they list it on the market. 90 days later, they can't get it sold. And they say, you know what, we've got to turn this into a rental. We're going to keep it and try and resell it again in the spring. Well, something that we had at Castle was a DSCR loan that you can rent the property out and we can give you a new loan based on the cash flow of the property. The problem that we ran into a lot is it had a 3-year prepayment penalty, that if you paid the loan off during 3 years, you had to pay an additional 6 months worth of interest. Well, here at Synergy, we can actually do that with no prepayment penalty. We can also do it with no closing costs. Now, if there's no closing costs, it's going to have a higher interest rate. But if you think, hey, I'm just going to keep this for a 6-month lease or maybe 12-month lease and try and resell it in the spring, great. We can refinance you out of a Pine Financial, 12, 13% interest rate, get you a 7.25, 7.5, maybe 8% interest rate, provide some relief on the monthly payment. You get the property rented out. Now you can hold it until it's a better time to sell. If we go back and think about, hey, it's not a great time to sell, let's provide you some financing options until it is a better time to sell. And again, we can do that with no closing costs in certain instances, and we can do it with no prepayment penalty, which I think is going to loosen up a lot of opportunities for investors that they have what I call a fix and flop, right?
Yeah.
We fixed it, we couldn't get it flipped. We're going to get it flipped in 6, 12,
We don't
18
talk about that on
months.
this show.
Oh, sorry. Yeah, that doesn't happen to anybody that we know. But if you're in that situation, call me. So there's a lot of things that we can do to help, maybe even before you list the property. And that would be kind of a one-on-one conversation that we can have to show you what it would look like if you don't get it sold the way you expect it to. How can we kind of rescue out of that hard money loan and have you keep it for a longer period of time?
That's so interesting you bring this up because this came up this morning too in our Minnesota market pulse about the fix and flop and going into your plan B, your exit strategy plan B.
Mm-hmm.
And a lot of times that is a refi. So this
Yeah.
exact thing came up earlier, and it's reminding me to just mention this because what you just said is so important, but you breezed by it really fast. So let's just make sure the listener understands that if that happens, if you can't sell it for what you want and you decide you want to refinance, you got to be very careful with your exposure in the MLS. If you drop your price below what you're hoping it would appraise for to get your refinance done, you could get yourself into a little bit of trouble. How can an appraiser appraise a property for more than it was listed for in the MLS and didn't sell for that price? It's clearly
That's right.
not worth that value. It's worth that or less because you didn't get a buyer. So the advice here is if your plan B is a refinance, be very careful with your listing. If your plan B is just to drop the price, well, then that's fine. But just be
But if your
careful there.
You are spot on, Kevin. If your plan B is, hey, we're going to keep it as a rental, please call me before you list it. And let's make a game plan. Maybe the listener and Kevin and myself or whoever your hard money loan officer is, if it's, Howie or Scott or one of the guys over there, we'll get on the phone. We'll walk you through. Here's a couple of steps we're going to take up front. So this plan B is available. There's a tiny little cost associated with it, not for the conversation, but to put that plan B into place. And I can show you guys a way that you can have that as a very, very easy downside protection. So I would welcome those conversations for folks that are thinking about listing a fix and flip.
Yeah, very smart, especially in a tight market like we're in now. So that's great. All right,
Yeah.
Joe Massey, we're missing Coop today, as you know. He
I
decided
know.
to move on to bigger and less important things, but we no, he's actually doing some very, very cool stuff. So I'm
Yeah,
super
he is.
proud of him, and I miss him. So we're going to continue just you and I for a while, and then
Great.
if we decide we want to bring in a third to help us with this market pulse, we could always do that at a later date. But for now, you and me, we're going to be doing this every quarter. So I appreciate your time, man. You put a little bit of effort into this. I know that. I could see that. And the listener benefits from that. And when you're doing that for free. So thank you so much for doing that, Joe. And for the
My
listener,
pleasure.
you could be listening to any other podcast. I know I say this every single week. There's lots of podcast options and choices, and you choose the Real Estate Educators podcast. And for that, I am grateful. So thank you for that. If you got some value like I did, learned something like I did, please 5-star review, share it with a friend, and I hope you make this day a great one. Thanks, guys. Hey, guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh, yeah, and tell a friend.